Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Friday. It's August 12th. It's about 7:53 in the morning. The market's going to open about an hour and 37 minutes to be specific with you. And by the way, have I been helping you out? Have you been benefiting from these videos? Post a comment below. Send me an email, support@marketgeeks.com. I think the market's about to turn, and I've got some news for you. I want to talk to you about this. So the market's opening up higher. Now, the last couple of sessions, we've opened higher. We kind of drifted lower, which is not a positive sign. Now, we do have some data today coming out in about 36 minutes, import and export prices. Now, here's the good thing. Import prices are, in fact, and I'm only looking at year over year. I don't care about month over month. Year over year, they're looking to be down, and export prices are looking to be potentially down a little bit as well. The prior was 0.7, now they're looking at 0.1, but we will see how much of a change it'll be. The consensus, as you can see here, is all over the place, not for the import, and I'm actually more focused on the import prices than the export prices, because America is much more on imports than exports, and import prices look to be down. This could be beneficial for the stock market as a whole. One of the things that I'm not too happy about, but I was expecting this to happen, I was hoping to get filled around here again, but the bond market is cooling off. This is putting pressure on stocks, whether you're seeing it already or not. It is, in fact, putting pressure on the stock market. Let me show you, for example, if you look at the 1 month, right? Consumer discretionary, information technology, the speculative sector. But look at the last 5 days. Things are starting to change a little bit. Energy, financial, basic materials, more inflationary type of stocks are moving. And even yesterday, this is today, but it's actually yesterday because market hasn't opened yet. Energy, financial, industrial, basic materials, consumer staples, consumer discretionaries all the way at the bottom, information technologies all the way at the bottom. So I would be very cautious right now because it looks to me like the market could be turning. Matter of fact, if you look at the SPY, I want to show you this right now. A lot of investors and traders believe that this is a brand new leg up, but we're still below the 200-day moving average. And I want to show you something pretty powerful. Let me show you this. Here we go. So these are all the major sectors, right? These are the major sectors. Look at the stocks trading above the 50-day moving average and look at the 200-day moving average. This is actually better to show than charts because this gives you the actual number. So look at this, consumer discretionary. Only 16% of the stocks are trading above the 200-day moving average. Consumer staples, you got 67. That's a defensive sector. Energy, that's a defensive sector. Financial, 27%. Healthcare, 38%. Industrial, 50%. Information, 38%. 29, 26, 19. And utilities, defensive. So you could see here the speculative sectors, the long-term trend on the speculative sectors is not really all that great. So if the market was to turn around right now and break lower, this would just appear to be a pullback from a major downtrend uptick against trend, because the trend is going down, not up right now. So to me, this looks like a counter trend move, and to me, it looks like a move that we were going to need to fade pretty soon, which is why I'm increasing bearish exposure in the position. You can't run away from the stocks, folks cannot run away from the bond market, especially discretionary stocks and speculative stocks. Now, let me talk a little bit about global economy. This is a good update. It actually encompasses everything that I've been wanting to talk about. United Kingdom reported economy contracted 0.1%, not too much, as families cut back on spending to cope with price increases. The decline was better than most forecasts. So things are a little better internationally as well. Now, here's the good stuff. The report Thursday showed that U.S. inflation at the wholesale level slowed, but more than economists expected last month, come a day after cooler than expected reading on inflation at the consumer level. That's the CPI and the PPI that I've been talking about nonstop. Such data have raised hope. Hope is the key word here amongst investors that a decade-high inflation may be close to peak and that the Federal Reserve will be less aggressive about raising interest rates than feared. I agree with that, but here's the problem, and this is kind of my fundamental view of what I was just talking about. Inflation is still painfully high, folks. Economy has given false signals before the relief was on the way, only for investors to have the rug pulled out from underneath them. And I believe that 100%. Some Fed officials have made comments after Wednesday's inflation report suggesting the battle against rising inflation is far from over. So I am telling you, as I am sitting here right now, that a lot of investors are being fooled and believe that this is a rally that is saving us, but it's not. It's just a rally going up to the 200-day moving average because things are better. But how much are things better? Are we done with this? No, not even close. We're still in the toilet. I mean, okay, we're not at a 40-year inflation high. We're at a 30-year inflation high. It's still terrible. And again, the bond market is already starting to cool off. And let me see if I can get my stock fetcher working. It was giving me trouble earlier today. And this is kind of what I wanted to show you right here. You'll see that some of these sectors appear to be fizzling out already. For example, consumer discretionary, that ascend you saw here is starting to fade a little bit. Technology opened up really high and pulled back yesterday. Industrial closed near the lows yesterday. Communication services did a reversal. A lot of stocks look like they're ready to reverse. So I would be very, very cautious. I'm liking energy again. I'm kind of liking again the stocks that I really liked in January, February, and March when markets got defensive. I like the consumer staples. I like the energy. I like the healthcare. And I like the utilities right now. I would be very, very careful with technology, consumer discretionary, communication services, and basic materials. I would be very, very cautious with that right now because the market is overbought. And here, I showed this to my guys yesterday. It was 4 something at like around 2 p.m. 358 stocks are making 20-day breakouts to the upside, and 20 stocks are making 20-day breakdowns. That's too much. You know, if you have 125 versus 20 or like 92 versus 4, that's normal. But when you start seeing 400, and let me see if I can make that number. Yeah, this is what I was talking about, 478 to 20. So the number's starting to decline, and I'm expecting more decline. And the fact that the market is opening higher is not making me feel warm and fuzzy. I believe volatility is going to start rallying from here on. I believe the bond market is going to stay right around the current level. And again, the fact that energy in the last 5 days, financials have been rallying. These are inflationary stocks here. So you've got to be very, 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 very cautious right now. Keep your eye on volatility. Keep your eye on the bond market, especially if it stays around here and doesn't go back up. This is telling us that inflation is pushing pressure on us once again. Now, I want to talk to you about the small caps. I think the biggest downside is going to come from the small caps, and I think we're going to come back down to this channel, and we're going to kind of, or maybe this will be the new, maybe the resistance, the old resistance will become support. But I think we're going to bounce off of this 200-day moving average pretty hard to the downside. Everything is pointing to it. Now, it would be great if I was wrong. If I'm wrong, that means we're going to enter a raging bull market. I don't think I am, folks. I think it's a little unrealistic, especially when you're looking at sectors and you're seeing all of this 200-day moving average. Look at this. This is a very, very weak market that's pretending to be a strong market if you look at the 50-day moving average. But if you look at the 200-day moving average, not even close. And take a look at Russell 2000. 79%, 41%. That's a big spread. 87%, 40%. Let's look at the NASDAQ. 36%, 88%. As a general rule of thumb, whenever the 50-day moving average is twice as big, the ratio, as the 200-day, it's a time to fade this market. Now, I want to show you something cool. We did this trade. A lot of traders believe options are only for short-term traders. I want to show you something. This is our discretionary trade list. These are signal setups based on the algorithm, but they're not rotational. They're not mechanical, like a dinosaur that just keeps moving and moving and moving. And this is from October 1st till present. We've done pretty good. We've every 1,000 would have turned into 6,435. Profit factor 121. In the worst market in years, average trade time 25 days, average return 3.35 net for every 25 days. So you're pretty much getting what the stock market gives you a year every 2 months, which is pretty good in this market economy. But here's what I wanted to show you. Look at the days we've been in some of these trades. 18% return, 57 days. 21% return, 79 days. 9% return on VIX on a put, 98 day. VIX, 95 days, 12%. AMD, 23%. You notice sometimes I'm holding options for 2, 1 day, 9 days, 3 days, 5 days, 7 days, and sometimes I'm holding them for 95 days, 98 days, 57 days, 79 days. Well, look at this trade. This is a UNM trade. We entered this trade on the 13th, right here, right around there. And look at what we ate with this trade, and then look at how we got out. That's this trade right here that we got out at 18.75. And honestly, if I held it, I got out here. If I held it right here, it probably would have been about a 35%. But I was very happy after being in this trade for 57 days to take 18.75. The point is, folks, there's a reason why I've been buying options that have a far expiration date, because we're dealing with a lot of unforeseeability right now, and we're dealing with a lot of volatility. And you have a lot of unforeseeability and you have a lot of volatility, you have to change how you trade the market. Now the market appears to be coming back a little bit. Look at volatility, for example. If you look at the Dow Jones, you will see, let me show you this. This is actually really important. It's right here, average true range, 10 days, perfect. Let's get rid of the RSI here. Look at volatility. The Dow went from, this is, let's see, let's go back here. How far back? I can't see any times. Let me reduce this this setting, make it small. There we go. Now I could see everything. Okay, so look at November last year. Volatility was $261 on a day, 261 points on the Dow. It went up to 755. 3 times. Volatility went 3 times. It's very, very hard to be predictive on the market when volatility is 3 times the norm. Now volatility is almost 400, about 393, 400 points a day on the Dow. Not 7, so it's about half of that. And I think with the market cooling off, it's going to come back. So it's very, very difficult to be accurate with short-dated options because volatility is so high. So don't be turned off by the fact that we're holding some trades a lot more than others. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 trades in a row, 16 winners in a row, and most of these options are dated. Look at this, November, September, October, August. And we got into these a long time ago, like Precision Profits 425, August option, 95 days. So there's an art to this right now. Now, if volatility keeps declining, we're going to start going less time on options and holding positions less. But right now, this was the proper approach. Now, folks, in case you haven't heard yet, I'm hosting a 3, yes, not 1, not 2, 3-day investment workshop next week. It's the first time I've spread it out in 3 days. I've never done an event like this before, and I've never taught how to do this. I'll be teaching you how to make your own at-home brewed ETF, homemade ETF or home brewed ETF. I like the home brewed ETF. It starts next Monday, August 15th. You do not want to miss out. It's going to be very, very cool. I'm not charging a lot of money for this. I'm doing this to help you guys out in the current market environment. It's really, really a bargain. And when I say a bargain, I mean a bargain. Follow the link below. Check it out. I've done seminars like this for thousands and thousands of dollars. That's not what this is all about. I want to help you guys. If you want to attend this workshop, make sure to reserve your spot. You can get all the details by clicking the link below. Do it right now. And again, there's a reason why we've been trading long-dated options. They've been working because of the volatility. When volatility comes back, and it looks like it's starting to, we'll go back to normal. Follow the link below. Send me some love letters. Send me some comments. I want to hear from you. I want to know if I've been helping you. Bye, guys. Have a great weekend. It's my first weekend back in Florida. I'm back to be home. Bye.